Now today we're going to continue with banker's right, and specifically we're going to start with banker's right of appropriation. Banker's right of appropriation. Now, what does it mean when we say appropriation? What is appropriation? Whenever the customer deposits funds into his account in the bank, it is the duty of that customer to inform the banker on how those funds should be appropriated. That is to say, when a customer fills the deposit slip, he or she needs to clearly state what account he needs or he wants such funds to be credited into. Where should the funds be deposited? Once the customer gives specific directions regarding appropriation, the banker has no right to alter or to question, even if there is an outstanding debt. Why? Let's recall duty or obligations of the banker. That is, a banker has a duty to obey customers' what? Customers' mandate. Therefore, if the customer appropriates, the banker has to obey. The banker has to follow customers' mandate. However, if the customer is silent, that is to say, if the customer does not give any instruction to the bank, then the banker has a right to appropriate in his own way. We're going to discuss this with some examples to make it clear to every one of us. Now, what happens if both the banker and the customer are silent? Now, if both bankers and customer do not appropriate, then the rules in Clayton's case will be applied in such scenario. Now, think of the following. Think of the following. We have a customer here, and I want you to understand one thing. In most cases, appropriation is attached on the current account. Okay? It's more applicable on the current account. Now think of the following. We have a certain current account here, call it, and is 3 logistic current account. Now this account has both debts and credits, right? Debts and credits on this account. Now, let's assume that first, the customer has, let's say, 3 debts. The first debt is of 10,000. The second debt is of 25,000. And the third debt is of 40,000. These are the debts that the customer, or these are the monies that the customer owes the bank. On the credit side, the customer completely has nothing, it's 0. Now, according to the right of appropriation, first one, right here. First one, when a debtor, now a debtor is a customer. Okay, a debtor is a customer. Now, when a debtor having several debts and makes payment with an express intimation that the debt be discharged against a particular debt, then the payment must be applied accordingly. Now we are going to see how appropriation works. Okay. So first, we have seen here that this customer has 3 debts of different amount. Okay. Now the customer pays in 7,000. 7,000 is not enough to pay any of the debt here. Okay, 7,000 is not enough to pay any of the debt here. In this instance, if the customer has just filled the deposit slip and instruct that the 7,000 be used to adjust the first debt or the second debt or the third debt, then the banker has to comply. The banker must comply. Number 2, when a debtor having several debts makes payment with no express intimation. When you say no express intimation, it means the customer has not appropriate. Now, if the customer has not appropriate, what will happen? The creditor, this is the banker now, the banker may apply his discretion to any lawful debt due and payable to him, where its recovery is not barred by the law. So we need to discuss something. What do we mean when we say barred by the law? But before we get to this, first, let me get back to this one. If the customer does not appropriate, the banker has a right to appropriate as he deems fit. It is that simple. So that is to say, the banker, if the customer is silent on this 7,000, the banker can decide either to use the 7,000 to adjust this debt or this debt or this debt. The banker can appropriate however he pleases. For example, the customer has paid in 10,000. Okay, the customer has paid in 10,000. Now, if the customer paid in 10,000 and appropriate, back to number 1, the customer paid in 10,000 and appropriate. How? For example, the customer says the 10,000 needs to be used to adjust the first debt. Okay. Now, if the customer wants 10,000 to be used to adjust the first debt, then the banker must comply. Number 2, the customer just paid in 10,000 but do not appropriate. The customer is silent. Now, if the customer is silent, then the banker can decide on what debt to appropriate or to adjust. So the banker can decide either to use 10,000 to decrease this debt from 40 to 30, or the banker can decide to use this one to decrease this debt from 35 to 15, or can decide to completely finish this debt here from 10,000 to 0. The banker can appropriate as per his or her discretion. Now, what is a debt that is barred by law. There are some of the debt has limitation. Okay, I don't know if you guys have ever heard of what we call the Law of Limitation Act. Okay, so some of the debts have limitation. Now, if the debt has a limitation, it does not mean that that debt is completely forgiven, or it does not mean that that debt does not exist. No. A debt that is barred, okay, a debt that is barred by time simply means the debt or the banker cannot use any other means to enforce a repayment. You cannot enforce a repayment. However, the debt will continue to exist. So it's up to you. If you have come into conclusion that completely this debt won't be repaid, you may decide to call it bad debt and completely take it out of your books. But if there is a way, or if the customer decides to come back to you and say, you know what, I owe you guys 40,000. I know there was a statute limit for this debt, but I want to repay your money, then you can take the money, no problem. But once it is bad, it means you cannot, or you can no longer enforce repayment of that particular debt. So here is the scenario. Let's assume that debt number three has a limitation. That is to say, by March 1st, 2023, this one will be bad by limitation. Now, if coming March 2023, this debt will be barred by limitation, remember, you won't be able to enforce repayment. And the customer comes to your bank and deposits 10,000 and say, I want the 10,000 to be used to pay debt number one. Then you as a banker, you're supposed to comply. So if the customer wants to appropriate or to settle debt number one, you cannot say that, debt number three has a barred by limitation and will be due on the 1st of March. So please, or let me redirect this fund to settle debt number three. You do not have that room. As a banker, you have to obey customer's mandate. What if the customer is silent? Rule number two, the banker is allowed to appropriate as he or she deems fine. You appropriate at your own discretion. Now, in this circumstance, it is worthwhile to adjust debt number three, because debt number three will be barred by limitation on the 1st of March 2023. So, a rational banker is allowed to appropriate or to adjust debt number three before he could continue with something else. This is here in number two. The creditor may apply his discretion to any lawful debt due and payable to him, where its recovery is not barred by the law. Now, what if neither the bank nor the customer appropriate? That is to say, what if both banker and customer are silent? Now, if both the banker and customer are silent, the payment shall be discharged in accordance with order of time, whether they are or they are not barred by the law. Here is where now the rules in Clayton case will have to apply. What does the rule in Clayton's case say? This was a very famous case back in 1816. Now the court gives the verdict as follows. Number one, the first item on the debit side shall be reduced by the first time item on the credit side. That is to say, first in, first out. The first payment in relation to the first payment out and vice versa. The rule may operate to the disadvantage of the bank in some occasions. I'm going to get back to this. First, let me explain what do we mean when we say first in, first out. We have a current account here. This, I'm going to give you a structure of a bank statement, how it looks like. Usually, we have debt, maybe transaction ID, which is not important to me right now. Then particulars of the transaction. And then here you have debit. And then you have credit. And here you have end balance. This is just a sketch of a bank statement. Now, let's say on the 1st of February, okay, on the 1st of February, XYZ pays, that is to say, XYZ utilize the overdraft facility. Let's say 10,000. This is money owed by the bank. I mean money owed to the bank. Let's say again, on 5th February, XYZ again paid another creditor a check worth 30,000. That means now the debt is 40. Let's say on the 10th of February, XYZ pays someone 25,000. This again is money owed. Therefore, the total amount of debt here is how much? 65. All right. That is to say, we need XYZ to deposit a check, or we need any other data out there to pay XYZ a check or to deposit fund that will equal 65 in order to offset all these debts. But now, we come to the first instance. XYZ, this is on the 28th February, XYZ deposits a check or deposits 10,000. If XYZ deposits 10,000 in this current account and appropriate, the banker will have to comply and follow the instructions. But if XYZ does not appropriate, like XYZ is silent, then the banker has a right to appropriate. If both XYZ and the banker do not appropriate, then the rule in Clayton's case will apply. Now look at this figure. 10,000 resembles a certain figure on this side, on the debit side, which is the debt incurred on the 1st of February. So impliedly, XYZ intended to get rid of the first debt. Now, what if it wasn't 10,000? What if on 26, forget the 28, let's say on 25, okay, XYZ deposited 15 or 10,000, then 26 February, XYZ deposited 20,000, and 28 XYZ deposited 15,000, and then for some reasons he disappeared. If these monies were deposited, neither the banker nor the customer appropriate, we see here that the rule in Clayton's case will apply. Now, if the rule in Clayton's case will apply, the rule says the first item on the debit side will be reduced by the first item on the credit side. That is to say, first in, first out. Therefore, first in, first out. First in, first out. First in, first out. Even though the deposited amount are insufficient. But that is how you are going to appropriate according to this rule, the Clayton's rule. The rule may operate to the disadvantage of the bank in some occasions. How? When an account is left to continue after the death of a partner. Now, if the account is left to continue after passing of one of the account holder, then the rule in Clayton case will operate to your disadvantage. So now, sometimes we ask you questions, how are you supposed to prevent this rule to act as against you? What you have to do is you close account. Okay, if we have three partners, X, Y, Z, okay, these are three partners. So they've opened this joint account. And for some reasons, XYZ is no more. Close the account, set off, and open a new account, which will have only these two guys, Y and Z. You continue with your business relationship. But if you continue using XYZ account while X has passed away, then this rule will never favor you. And that is what happened on this famous. Now, how to avoid the operation of the rule to operate against the bank? The bank has to rule off. To rule off means to set off. The bank has to set off accounts and open a new account in some events such as death to joint account holder or on the revocation of a guarantee. Why? So as to determine the liabilities of parties involved. Now, a right to set off enables the banker to combine two accounts in the name of the same customer in order to adjust the debit balance and credit balance to arrive to net debit or net credit. The banker can decide to issue a notice. However, there are some instances where the banker cannot issue a notice that is going to exercise the right of set off. For instance, in the instance of bankruptcy, okay? In the instance of bankruptcy. Again, in the instance of the death of the customer. In these two instances, the banker is required by law to set off the account. Now, what are the conditions necessary for exercising the right of set off? Number one, accounts must be in the same name and in the same right. The right can be exercised in respect of debt due and not in respect of future debts. We have already discussed this, the first one, maybe this one. The right can be exercised in respect of debts due, matured debts, not future debt. Right? So, if there was an intention, let's say, for your customer to borrow funds, however, the funds are not yet disbursed, then that does not qualify to be termed as a debt. A debt, that means 100% a customer owes some money to a banker. Again, the amount of debt must be certain, like it has to be in absolute terms. For instance, the debt is, let's say, 10,000 USD, not relative term. The right of set-off may be exercised in the absence of any agreement. Remember, in some instances, set-off is required by law, like for instance, in case of death or bankruptcy of the company. Therefore, whether there is an agreement or not, the banker is required to set off. Now, the opposite of the condition that I've just mentioned simply means the condition under which a banker cannot exercise the right of set-off. A banker has a right to claim incidental charges. We all know that a banker incurs a lot of expenses in order to offer services, appropriate services to their esteemed customers. Like a banker needs to pay salaries, utility bills, rent, okay, etc., etc. Therefore, a banker has a right to charge a commission or interest or any other charges due to the services that are offered to their customer. The law of limitation on a bank deposits. Under the law of limitation, generally a customer gives up the right to recover the amount due at a banker if he has not operated his account since last 10 years. Then there is a right to close account. A banker has a right to close customer's account and discontinue operations. The process terminates the relationship between banker and customer and is done only in situations where the continuation of the relationship seems unprofitable to the banker. At all times, the banker is required to give reasonable notice before closing the account. Some of our customers might be engaged in some shady deals or illicit businesses that can pose reputation risk to the bank. For instance, you come to conclude that your customer has been involved or accused of embezzlement, government funds, for example, public funds, etc. Then that customer poses reputation risk to your bank. For that reason, it is much better you discontinue the relationship by closing the bank account. However, since that particular customer's account has some money, you have to inform him in advance that we intend to close your account so that this customer will have time to make necessary arrangements. Probably there are some banks out there which are willing to accept that degree of risk. So you need to give him time so that he can make some arrangement with some other banks. Remember, by closing a bank account, you are simply terminating the relationship between a banker and a customer, and to be precise here, debtor-creditor relationship. However, at all times, you shall maintain the duty of confidentiality. Therefore, closing a bank account does not render obsolete the duty of confidentiality. Now, in closing account, if a customer directs the banker in writing to close account, the banker is bound to comply with such a discretion, no questions. Even though I understand that sometimes you summon the customer, sit down and start discussing, like, okay, why do you want to close account, blah, blah, blah. Fine, that is due to the nature of relationship that we have built, but actually you're not supposed to ask questions. The account must be closed with immediate effect, and the customer is required to return all unused check leaves. The banker is also competent to terminate his contract with the customer if we find that the customer is no more a desirable customer. A desirable customer is a customer who has some interest, or who the banker deemed that he will assist the bank to prosper. But if you think that the customer jeopardizes position of the bank, then you have a right to discontinue the relationship. The banker should give to the customer due notice of his intention to close the account and request him to withdraw the balance standing to his credit. Okay. This notice should give sufficient time to the customer to make alternative arrangement. Now, if you as a banker has reached into the decision to close the account, this is what you're supposed to ask the customer to do. Number one, the customer needs to surrender all unused check leaves if the account is a current account. He must return account ID, ATM cards, and any other bank items. And also, if there are some charges, then the customer needs to pay all these charges before the account is closed. Now, again, what if there are some debts? Remember, you have to set off, and once you set off, then you'll be in the position to repay those debts, and finally give the customer his final bank account statement. Termination is of the contract between the banker and the customer, and not the relationship between the two parties. That's the reason we say banker-customer relationship is everlasting. Termination is the contract. For instance, the contract was the customer to enjoy bank account. That is the contract. So that is the one that will terminate. Now, this contract can be terminated in three ways. Number one, by the customer. Now, if it's by the customer may demand full payment of his credit balance. That is, the customer may demand to withdraw all the funds in his account. The customer does not necessarily have to inform you in advance that today or tomorrow they're going to close a bank account with you. And the customer may decide to close the account simply because they are changing their area or the place where they use, for instance, they used to live or to work. Let's say your customer is moving from your country to the other country. Again, the customer may decide to terminate the contract if they are not satisfied with the way you guys are operating the bank or they are operating the account. That's the reason I think we have what we call customer care. Customer care there, besides other issues, also to retain these existing customers. Because if you let go your existing customer, you are running the risk of losing even prospective customers. Number two, termination can be done by the bank, okay, and there can be a number of reasons that can lead for the bank to decide to terminate the contract with the customer. Now, Again, if it's the bank that has decided to terminate this relationship, then ensure that you give sufficient notice so that the customer will have time to make some other arrangement. Remember, following the termination, the duty of secrecy will continue. It is everlasting. However, it is not absolute but qualified, which means there are some incidences where you may be allowed or authorized to reveal customers' information without suffering some consequences. Last, termination by the bank can be due to some or the following reasons. The bank has come to the conclusion that the customer does a lot of forgeries, theftiness, embezzlement, negligence, or the customer has passed away, or the customer is of unsound mind. Again, if the company is insolvent or under liquidation. And last, termination by operation of the law. Operation of the law, that is death of a customer, insanity, bankruptcy, or insolvency. Gentlemen, ladies, that marks the end of this topic, bankers-customer relationship, duties, rights, and obligations. Thank you for your patience and your time. Again, I invite you for some questions and discussions.